Okay, happy Friday everyone. So I'm going to be delivering the brief today. It is the 9th of March. Topics going to be covering today is going to be the ECB event we saw yesterday. I'm going to be looking at the US equity markets, commodity markets, so broad-based analysis across the assets. Then we're going to turn towards some of the data and news flow we've seen overnight. And then wrap up just going over what we're expecting for non-farm payrolls and its possible implications on the market. So we're going to start off as always with the charts. So if I just transition over, let's have a quick look, and let's start with the euro dollar, which really was the main driver yesterday. If we have a look here, obviously yesterday was the ECB interest rate decision press conference minutes, and what you can see here is the market, after having quite a choppy session over here, really did come under some pressure, and the euro did fall, breaking a sort of intraday range, which then had implications on the European equity market. But this was a tricky event to trade. Nothing really new being seen. This first initial drive here we saw higher, driven by the ECB dropping their easing bias, which was something which they added in 2016 to state that if necessary they would increase their quantitative easing program above the current rate, which was at 30 billion. So this saw immediate upside. People were getting a little bit excited about this. So I would have said, in terms of market positioning and market pricing, all it did is it took us back to the 8 a.m. high, so the European morning high, which, you know, we traded there before the data. We started trading there, and then we sort of stagnated here, waiting for the press conference. As the press conference started, I feel a little bit more technical trading. There was a slight revision upwards to the 2018 GDP forecast of 0.1%, allowing euro-dollar to rally a little bit. But this was of no surprise if you think about it in context. To expect them, nobody was expecting them. The conversation isn't regarding them increasing their quantitative easing program. The question is, when are they going to end it? Are they going to end it abruptly in September? Coming into this question is, are they going to end it abruptly in September, which really was the bigger risk? Or are they going to end it by the 2018? Those are the only two real options. So the fact that they got rid of the easing bias, I mean, we did see a little rally higher, but in terms of market positioning, only took us up to the European morning, that slight revision higher in growth forecast, which again is no surprise. We've been having really good data out of Europe, allowing us to rally a little bit. So this was, I was working with the stage 2 guys, and you know, they're obviously one of the most first press conferences they're trading, and you're seeing this market volatility, but just having to repeat, look at where we're positioned, look at where we're positioned, and ultimately, you know, we're trapped in our 2-day range. If the guys are a bit more experienced, everyone knows that once a central banking meeting, to expect us to rally past R2 or rally below S2 is absolutely normal. So being trapped within these two-day range really meant that the market was sort of comfortable with what happened. We rallied a bit harder. During the press conference, Draghi did just go on to say that this is something we introduced in 2016. We'll still provide accommodation, and was very easy on his stance towards ending accommodation. As always, still mentioning the fact that inflation is a bit lackluster. Ultimately, after the press conference, we trickled down to our lows, finally making a push lower at 2:50, nearly 3 o'clock, and that caused the euro then to decline, having cross-asset class implications. So if we have a look at the DAX, this was the level we'd been watching quite closely. I know Sam was posting charts about this level for a few days coming into this, and this was just this technical level here, finally giving way. That the risk of this sharp taper to the QE program sort of coming to an end, allowing the DAX to finally reclaim this very strong technical price point. And I mean, something I want to stress, especially some of the newer guys, is this is trading. When you're waiting for levels like this, we know the market is interested. This is buyers in control, sellers coming in, retaking this level, sellers dominating around this level. And then finally we have a breach driven by a fundamental news, allowing us to rally up until this R1 level. It was a great trade to take on, and you know, this is something you should have had on your radar now for a few days, if not the whole week. If this level gets reclaimed, that's going to be a trade. So there were a few opportunities. The euro here The play on the lows, taking it past S2 is always a bit painful. You can see just how many people are interested in trading whilst we're contained between pivot S1, R1, etc., even from S1 to S2, but then you sort of see this low volume sort of trading, not many people being too aggressive, just allowing the market to sort of drift a bit lower. So ultimately a dovish reaction, allowing European equity markets to be lifted. The risk of QE ending sooner rather than later means more demand for bonds. So after that initial hawkish commentary and yields spiked, therefore the prices fell. Market determining this as a dovish event, allowing the Bund to reclaim more losses and then go print its highs up at about the weekly highs, coming to the top of the range and just at the moment settling there. Having a look at the euro, very much at the bottom of the range, coming under a bit of pressure at the moment. So in terms of bias for today, definitely euro weakness following this event. DAX, for various reasons, I'm still bullish. I mean, if we can get back down to this level here, very, very keen to get involved. Also, Euro stocks here taking a lift on the back of this, albeit not so aggressively. This was not the most exciting trade in the world, but there was an opportunity for people to get in at R1 and then book some profit as we came up to this previous high here. And if anybody didn't book profit at this point, I think that was largely driven by greed. So that wraps up the ECB meeting. So it did have an interesting impact on the market. It just took a bit of time to filter through. Then have a look at the US equity market, and once again, nice positive day here. You can see we have been recovering. It's not been the most aggressive move higher in the sort of equity market, but this was driven, first of all, given an ECB event, DAX being lifted, putting some risk positivity back into the market, filtering through into the US equity market. But then there's also a couple other things. We've got Kim Jong-un and Donald Trump sitting down for a meeting, the first such meeting. And I feel like, yes, this did trigger off a risk-on move, particularly in your Asian assets, because if we think about sort of the commentary that we've been hearing, so just as I find, yeah, the right commentary, the right Bloomberg page, let's take into consideration here, Fire and Fury, Little Rocket Man, these sort of comments, given the fact that they're both nuclear nations and sort of, not the most diplomatic, to say the least, there was some tail risk that this would escalate quite quickly. And that was obviously weighing on equity markets somewhat. I wouldn't say too much. Mainly weighing on the Asian equity market as opposed to US equity markets, where there's sort of other things being taken into consideration. My view on this is, yes, the Asian markets rallied. You can see here the KOSPI, TOPEX, MSCI, Asian Pacific, and the dollar yen, the yen weakening. Risk on move, equities higher, up 1.8% here. I want to see how the story develops. I am not going to be going long equity on the back of this news flow at the moment. I, in fact, think in the bigger picture, this escalates risks. You have two very brittle men sitting together who've already hurled insults at each other. They're not the most diplomatic, so for them to be sitting in a room, I mean, hats off to Donald Trump if he can do it, but this is very much going to be an unscripted conversation. And Donald Trump has fallouts with his closest allies, and I mean, if he's been hurling insults left, right, and centre to this person, I'm not too convinced. But at the moment, at least the Asian markets, positivity, KOSPI, and the TOPEX. You got the yen weakening. Yen is also weakening following some commentary coming out of Kuroda last night. So this was to say, Bank Governor Kuroda says hitting a 2% inflation target during fiscal year 2019 will not immediately trigger an exit policy. Kuroda has been surprisingly hawkish recently, what I mean relative to his normal stance. So he is just changing his tone a little bit, and I feel that may very well be driven by the fact, driven by the fact that the yen is actually quite strong against the dollar on a sort of longer time frame. So maybe just easing up his bullishness on the Japanese economy. You can see really have been taking a hit as this dollar continues to weaken and this exchange rate's becoming less and less favorable for them. This, oh, sorry, let me transition. So this is the chart here. This dollar yen coming down, so this is less favorable for Japan. So maybe after showing a bit of positivity in the underlying economy in Japan, he's now starting to take a little step back to ensure he doesn't do any outward harm. Another trade idea, one of the traders was looking at, which I think is worth noting, was a great technical trade on Dr. GBP. So this is the CFD. There was a great, interesting trade here. If somebody was looking for a trade in which you can go short sterling, betting against this Brexit negotiation, this Brexit deal going smoothly, and expecting risk appetite to increase. So looking at these currency crosses can be quite interesting. So we've got this quite a strong trend line here. If it does come up there and test, that may be an interesting place, subject to what your views are on the UK economy as well as sort of global risk. So looking at these interesting currency pairs, definitely something to keep an eye on. So that takes us through to the US equity market. Finally, I just wanted to talk a little bit about the oil market. So if we have a look at WTI crude, we have seen a bit of sustained pressure coming through in recent weeks, and this is just following on from the DOE reports where we saw an increase in output production by over 0.8%. Now we were expecting, I think, what was it, a build of 5 million, we got a build of 3 million, so effectively a draw of 2, seeing some upside in the oil market. But this is following that 3-tier way that oil moves. First is the headline, second the whole report, and third the US output production. So that lesser build driving the price of oil higher, and as this is happening, people are digesting the rest of the report. Nothing too important there, but then seeing the largest producer in the world increase their production by 0.8%, that gave the oil some legs to downside, and that causing oil prices to fall from the 62.50 level down to 60. So almost a $2 move. That's a very, very strong move to the downside. Then sort of consolidating at the bottom of the range, another technical opportunity going short the high the next day, stop behind pivot, driving it down right to the bottom of the range, and now we're sort of consolidating at its low. So oil's been an interesting market recently. From a market which sort of did what it wanted to do, irrespective of risk or anything, it's been an interesting market to watch recently. It's regained its strong degree of correlation with the S&P 500. So if we have a look here, this is the oil market and the S&P 500 on a 2-hour chart each. And ever since really the sell-off we saw in the US equity market previously, over here, you can see risk appetite. Before there's a bit of a divergence over here, but ever since we saw that sell-off, we've seen this correlation between the two, quite a close correlation. So it's almost, I'd say, keep an eye on this. It's once again a good indication of what the equity market is going to do. Not just obviously the oil and gas stocks in the S&P 500 giving it that correlation, but also the fact that these have both been being governed by the dollar more than risk. And I do appreciate for new traders, it has been a difficult couple of weeks because correlations have been tricky, to say the least. I mean, it's either being driven by the dollar or risk, and in dollar or risk environments, the market will react in two different ways. Let's give an example. In a dollar environment, gold will rally, equity will rally. In a risk environment, gold will rally, equity will fall. So oil has been a sort of staple up until obviously this fundamental driving factor allowing oil to fall in equity markets. Still rallying on the back of this risk on move. So divergence definitely taking place here. Just having a look at this is GCE and S&P, so this is your S&P and gold. Divergence taking place here again, but you could see when this was driven by the dollar strengthening or dollar weakening, equities rallying, gold falling, S&P falling. So correlations have been difficult, but we are sort of falling back into gold going lower, S&P going higher, being highly indicative of risk-related moves in the S&P versus the gold. So do keep an eye on it. Don't take correlations for granted. Correlations at the moment have been very, very tricky across the board. So I'd say evaluate correlation. And what I've been finding particularly useful is just have you should be doing this anyway, but having an outright view on each product as opposed to trying to be too responsive to this market. There are factors affecting the oil market, the yen market, the dollar market, and US equities. So have an outright view on the market and maybe look for a bit more confirmation as opposed to saying because gold is doing this, I speculate that S&P is going to do this. Definitely not the right environment for such correlation play. That brings us to your commodity prices. So we've spoken briefly about the FX, the equity market, as well as your commodities market. What I did want to also touch upon is some data we had overnight. So if we go through our calendar, you should be starting off every morning when Friday, having a look at what happened overnight. Now, having a look overnight, this initially caught my attention very quickly. So we saw an inflation rate for February, so the month just gone, reading 2.9%. Let's put that in context. The consensus was for 2.5%. If we saw this in the United States, equity markets would be in bear territory within a week. But let's have a look at it on a chart. If we had a 0.4% beat, steady tracking around 1.9, 1.7, 1.8, 1.5, and then we see this explosion higher. We're trading at now 2.9%. Looks like it's the highest price we've been trading since 2014, and on a 10-year chart, really at the top end of about decade high. So that should have been an initial cause for worry. So just flicking through and trying to find some more details on this. China consumer inflation jumps 2.9% in February. So let's have a look at what was causing this. China consumer inflation categories. You got food and alcohol and tobacco, residency, transport, communication, medical treatment, and headline CPI being the black line here. And so your various components. The big standout here is clearly this green bar here. So driven by medical treatment. So I mean, this is something which central bankers may call idiosyncratic factors, as seen by the late Fed chair Yellen and ECB Draghi. So, I don't think the market has been too concerned by this. It would have been very different if, let's say, your transport had rallied, your residency, your food and alcohol prices had gone up, education costs had gone up. I mean, yes, medical treatment is important and everyone needs it, but is it so important that it's going to start to cause global inflation fears? But I think the market will be taking this into consideration because we are looking at global tightening of policy. So any sort of beats like this will catch people's eye. Right now, they seem to be writing it off. No risk as of yet being seen in the equity market. So the next up in the calendar, having a look at this, is your UK data at 9:30. So we have construction, industrial output, manufacturing output, goods trade balance. So we have some UK data, which is all in its essence is not that important given the fact that it's for January as opposed, and we're now sitting in obviously March, so lesser importance. If anything, the industrial output, manufacturing output wouldn't be too market moving anyway, as a consumer society as opposed to a producer society. So keep an eye on the trade balance to see potential market volatility, but that will have limited effect if you are going to be getting involved in this UK data in and out. Why is that? Because we have non-farm payrolls today. So non-farm payrolls is non-farm payrolls is ultimately what caused the sell-off in the US equity market. So here we are, a month later, and we are coming into the same set of data which caused this sell-off in the US equity market. So this is going to be important. People aren't going to be willing to trade. They're not going to be willing to trade bonds, equities, commodities, anything ahead of this data. So my advice to everyone would be just keep calm. No trading today. If you're going to trade these UK numbers, manage expectations. The January reading, I don't believe they're going to be very market impactful, and even if they are a massive divergence, maybe there's a short opportunity, but be careful. There's no point looking at this data calendar. So we all know the game plan for this. We've got average hourly earnings, but before that we have our payrolls number. So non-farm payrolls, your expected job creation headline number, which is not going to be too market impactful. Let's have a look at where we've been trading, where we've been printing recently. So where is your non-farm payrolls? Non-farm payrolls for the month of February. Here we are. So Consensus today is for 200,000 reading. It never really varies that much, but that's not too exciting. Sort of in the middle of the expected range. This number can be quite volatile, goes up and it goes down. So again, headline very minimal move. You may see some algorithms trade it, and you may see initial spike in volatility. I'd generally say stay out. Having a look at your unemployment rate, this is tracking at multi-decade, about 14-year lows. So very, very low at the moment at 4.1%. Market's expecting this number to track down to 4%. Now, I kind of feel that if we trade this sort of psychologically, I think 4.1%, everyone's saying, well, now we know unemployment is very low, it's not going to be that important to the market. But I think when we hit the 4% mark, I think fears are going to start to rise, even if that hasn't followed through just yet into wage growth. That, statistics don't lie. In the past, if unemployment has fallen, job creation has gone higher, inflation has ticked up. So I think if we hit the 4% mark, this might cause some movement in the market, but the main takeaway from this is going to be your average hourly earnings. Just having a look for the number here. So average hourly earning month on month, year on year. Of course, the year on year is what moved the market previously. So what we're expecting here is for, just get the calendar up. Month on month consensus, or expectation here, is for 0.2%, previously 0.3%, so a slight downtick in your average hourly earnings month on month expectation. Last month, the 2.9% versus the 2.7% is ultimately what caught the market's attention. It caused the equity market to fall, dollar to strengthen, all in the fears of US interest rates going up a bit too fast. So right now we're expecting it to tick down to 2.8%. So actually expecting a decrease here. So market's going to be very, very sensitive to this number. So I'd be careful going into this. I think the risk, of course, is that your number comes in higher than expected. So if we get a 2.9% or let's say 3%, absolutely that would be a tradable opportunity. You could almost just trade that number, and people will, if we saw 3%, I think every other aspect falls to a side, whether that's your employment numbers, so how many jobs were created, or any other aspect of this report. So 2.9% we'll see some modest dollar strength, or if we see 3%, then absolutely equity markets may come under some pressure. So just have a look at this chart in terms of which equity market should we be concerned with. Well, you've got your S&P 500, you've got your Dow Jones, you've got your NASDAQ. So let's have a look at where we are trading in each one of these assets. So we're going to 480 just so we can see this downtick. So the S&P 500 is very much just about retracing 50% of its move here. So going on here, drawing up your Fibonacci just to see where we're trading. Let's go from the all-time highs to the lows. Or let's start from the day when non-farm payrolls came out. So going here, I believe it was this day here. So, from all-time highs, we're down about 50% since the non-farm payrolls report. What is that? We'll retrace majority of the move, but if we compare this, let's say the Dow, let's just compare it from all-time highs to its lows, because that's basically where we were trading. So, having a look at the Dow is exactly on the 50% fib level, providing some support. Has chopped it up a little bit, but let's look at how this level has reacted, if it's something worth considering at the moment. So we found some resistance initially, some resistance. We break through it, we find some support. We have some support, some clean tests, etc., etc., etc. Now we're just waiting, and I wouldn't be surprised if this market doesn't go anywhere. Also coupled with the 25,000, so this market's just going to stagnate here before the non-farm payrolls. Either we rally, as in average hourly earnings come in at expectation or lower, or we start to fall. And if we do start to fall, I definitely have these big markets, big levels marked up. So I'm saying 2.9% or higher on your year-on-year. Sort of this low over here that we saw on the 20th. key support level on your longer term. You got this low down here. Going on to your shorter term charts, having your pivot level. So, you know, anything, you know, it would be a very aggressive move to the downside. Picked up algorithms. A break of S1 would really allow the market to sort of start drifting a bit lower. We got some previous support from this gap here, S2, and then the market will start to find some legs. Vice versa, if we see a strong number, this R1 is quite crucial here. Top of the range, coupled with 25,000 level. Dow being quite interesting. The Nasdaq, sorry, got a little bit off topic there, so I wanted to draw a Fibonacci here as well. Pointer tools, Fibonacci retracement going from the all-time highs, and you can already see just how different this market has been responding. A degree of its liquidity compared to the S&P 500. You know, when we went to go test its lows, you can see it was significantly underperforming, taking out its lows by, you know, notable amount. I was watching this market the day that was happening. It's happened quite late in the night. Some really heavy selling pressure. You know, we made a low of another 1.5% from its inflation fear lows, while the Dow Jones, if you go into a longer time frame, you know, hasn't even gone to test it really. The S&P touched it and bounced off. So the Nasdaq first was underperforming, and ever since then it's been rallying, and now it's right at the top, almost looking to touch its all-time highs. And I mean, if we get a number in line with expectation, you know, I think one of the safest trades we can say is that we are going to go look at this all-time high. I mean, in terms of probability, it's going to be extremely high. This risk of inflation ramping out of control starts to abate, and we go to see the all-time highs. And then it's going to be interesting to see whether Nasdaq can close above this or below this. If we hit it, we will test it, probably print a new high, but then can we close above it or close below it will really determine whether in the forthcoming weeks we have an opportunity to then be going long the Dow Jones and the S&P, because, you know, I would struggle to see the Nasdaq being able to sustain itself at all-time highs, close above its previous all-time highs in a number of days, and the S&P and Dow sort of continue to be, you know, 50% off their leg lower. So there may be a catch-up game here. My bet is that we're going to go see the all-time highs if we see inflation, average hourly earnings at expectation. We'll go test it, but ultimately we'll fall down. I don't feel Nasdaq will feel comfortable or just to be sitting above this all-time high, while the S&P and Dow are lagging behind so significantly. So equity market of key interest here coming into this. The dollar has weakened quite significantly. Well, let's just have a look here. Since that event, this is the peak of our dollar strength here, so we have weakened in terms of this. You know, we've got a floor at the moment, this 1, 2, 3 level. Any break of this, I'm sure Sam will be going through some more charts as the day progresses. But yeah, we have a floor over here. So all eyes on this non-farm payroll event. And just to quickly wrap up, I just wanted to go through sort of market expectation. We're currently pricing in 3 hikes, but let's see how the market is actually priced. So 21st of March, 88.8% expect 1.5 to 1.75, so a hike expected. Coming into May, you know, no expectation to change. Obviously, it's not going to be your full press conference afterwards. Then coming into 13th of June, let's have a look there. So here we are expecting a hike here. Coming into 13th of June, we're expecting 1.75 to 200. So this is priced in. 13th of June is priced in. August, well, there's not going to be priced in. There's no press conference. Let's go to 26th of September. 26th of September, almost. We have almost priced in 26th of September. You know, even if your month-on-month comes in a 0.1 beat, I reckon this is now going to be priced in. So that's your 3 hikes priced in, and that obviously leaves the opportunity for December to be priced in. So 225 basis points. At the moment, nobody has priced in the final rate hike at 2.25 to 2.25. Yeah, I mean, it's significantly lower at the moment. So if we start to see a beat, it'd be interesting to see how these expectations change. But right now, 21st of March priced in, 13th of June priced in, 26th of September priced in. We have 3 hikes priced into the market. If somebody could tell the dollar that would be great. But the risk is obviously higher average hourly earnings, inflation fears pick up, and the dollar strengthens. And I think given where the dollar is trading against the euro, and it's just sort of systemic weakness we've seen in the dollar for the past few months, that would be a very interesting trade. Okay, guys, so that's it for me. Thank you very much. And if you have any questions, please do drop them in the chat. Have a good day.